Today I would like to analyze UnitedHealth, one of the worst performing stocks in the last month. We are down around 53%. So in this video we're going to talk about why the stock declined so much in just 1 month, and we're also going to take a look at the financials to find out if it's a good buy right now. We have three main reasons for this extreme stock decline. So the first one is the ongoing investigation of US officials over possible fraud. So this is a very serious matter. We also have the CEO resigning, so again, not a very good sign. And we have weak forward growth projection. This is something we also don't like to see. Now we're going to take a look at the financials. The first thing we can recognize is a market cap of 248.87 billion US dollar. This makes UnitedHealth the largest healthcare company in the world by the market cap. We also have a dividend yield of around 3.06%, which we can see here did grow in a good rate in the last 10 years. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 257 billion US dollar. This was a decent growth around 6%. In 2021, we saw the good growth around 11%. In 2022, we saw again the good growth around 12.7%. In 2023, we saw the even better growth around 14%. And then in 2024, we saw the decent growth around 7.7%. So it's a check here in revenue growth in the last 5 years. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 20.1 billion US dollar. This was a very good growth, around 22% from 2019. Then in 2021, we saw the decline around 1.16%. Then in 2022, we saw the very good growth around 17%. In 2023, we saw the good growth around 9.7%. And then in 2024, we saw the strong decline around 20%. So in the last 5 years, it's still a check here. We saw the very slow growth. The next thing we're looking for is a free cash yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. 20.71 billion. We're going to divide it with the current market cap, 248.87 billion. So then we're going to get the free cash yield for 2024. So the number we're going to get would be around 8.32%. So that's a very high free cash yield, and this can be an indication for undervaluation already. So it's a check here. We should also make assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025, the free cash flow could be around 27.5 billion US dollar. In 2026, around 29.8 billion US dollar. In 2027, around 34 billion US dollar. So these assumptions are probably very high. So let's assume very pessimistic for 2027, around 24 billion US dollar. So we're going to use that number and we're going to divide it with the current market cap, 248.87 billion. Then we're going to get the free cash flow yield around 9.64%. So this is again very high, and I think a very high indication for undervaluation right now. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. This is around 71.29 billion US dollar. Then we're going to add the short-term debt as well. We can see here around 5.2, and we're going to add this number as well, the 4.8. So all in all, around 10 billion US dollar. We're going to divide it with the current free cash flow. So this is around 20.71 billion US dollar. Then we're going to get the debt to free cash flow ratio around 3.92. So this is a decent number actually. It means a little bit under 4 years we can repay the debt with the free cash flow. So the check here, and we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 30.72 billion US dollar, and I think this is also a very good amount. So overall, this company has a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 248.87 billion. We're going to add the debt as well. This is around 81.29 billion. We're going to take minus the cash, 30.72 billion. So this is the enterprise valuation of 299.44 billion US dollar. This is how much the whole company is worth. Then we're going to divide this number with the current free cash flow, 20.71 billion. So then we're going to get the enterprise valuation to free cash flow ratio of around 14.45. So this is a great number actually. It's under 25, so it's a very high indication for undervaluation right now. We can also calculate this number with our free cash flow assumptions for 2027. So this would be around 24 billion US dollar. So then we're going to get a different number as well. So the number we're going to get for 2027 would be around 12.47. So again, a very good number and a high indication that this company could be undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially if we think the company is undervalued. We can see here, yes, this company buys back a lot of their shares. We can see sometime even over 1%. So this is something we like to see, and it's a check here. Is UnitedHealth stock a good buy right now after the 52% decrease in 1 month? So let's start with the positive. So we had a good revenue growth in the last 5 years. We also had a decent free cash flow growth as well. The balance sheet is also looking quite good. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 8.32% is looking quite high. This can be an indication for undervaluation. Then in 2027, with our free cash flow assumptions, this number could be around 9.64%, which would look even better. Our enterprise valuation to free cash flow ratio around 14.45 is also an indication for undervaluation. We want to see that number under 25. In 2027, this number could be around 12.47, which would look even better. What I don't really like to see is a fraud investigation. This is some risk we need to consider as well. And we also have a weak forward growth expectation. So overall, I think this company can be a good buy right now because the valuation seems very undervalued at the current point. If you found this video helpful, don't forget to like and comment and subscribe for more content.